First-time home buyers is my specialty. It's my niche in the industry. There's two main products that I like to offer for first-time home buyers. The first one is an FHA mortgage. What an FHA mortgage is basically it allows you to put as little as 3.5% down of the purchase price. So that would be your total outlay out of your bank account, 3.5% down. You can get 100% gift money from a relative, and you can also go up to a 6% seller's concession for the closing cost and escrow prepaids. And what does that mean to you as a buyer? It means that you can keep more money in your bank account, stay liquid for a rainy day, such as if something was to happen down the road and you needed quick money, it's in your bank, keep it there, stay liquid. The other type of mortgage product for first-time home buyers is your conventional type of mortgage. Conventional, also known as a Fannie Mae type of product, allows for as little as 3% down. Guidelines are a little bit more stricter when it comes to income qualifying, but the mortgage insurance, if you were to put 3% or 5% down, are very, very low in today's standards compared to years ago. Mortgage insurance companies are very, very competitive, and the mortgage insurance monthly premiums are a lot less expensive than they were a few years back. So if you were a first-time home buyer with little income in the bank, little savings, FHA might be a better program to go as opposed to conventional. Conventional is more for your 700 plus buyer that has been on their job, has large income, has a large savings, but I don't want you to think that there's a myth in the industry that the first-time home buyer has to put 20% down. By all means, that's not the case. You could put as little as 3% down and still obtain a mortgage and be approved. So let's talk about pre-approvals. It's my job to supply a pre-approval letter to the real estate agents such as Tommy. And why is that? It allows Tommy to see the buying potential for a particular buyer. And what do I, as a mortgage loan officer, look at when I'm pre-approving a client? Well, the first thing I look at is their credit. Always, first and foremost, I have to run the buyer's credit. If they're married, I run it as a joint credit report. If it's, you know, a person and their fiance, I run it separately. Now, again, there's a myth in the industry that they have to have perfect credit. By all means, not at all. We can go down to as little as 550 credit score. You will get better rates and programs if the credit score is at 600 or higher, but we can go down to as little as 550.
Joe, why don't you tell us a little bit about the different programs? I know that we do have here the FHA and the conventional, but just briefly, give us a little bit about, a little information about a first-time home buyer and what an FHA
can do for them. Well, like I touched base earlier, the FHA loan can get you in a house with as little as 3.5% down. If we structure it in a way between the seller concession and you can get gift money, basically you could get it done with zero or a little out of pocket and keep your money in the bank. It also allows for a higher debt-to-income ratio. What does a debt-to-income ratio mean to a first-time home buyer? Well, basically what I'm looking at is all their total liabilities. Not really the balances, but I'm looking at minimum payments. If they have an auto loan, if they have student loans, if they have credit cards, I'm looking at all of those payments that are on their credit report, plus a proposed mortgage with taxes and insurance, and I'm dividing that by their gross income, okay? If they're self-employed, I'm taking a 2-year average of their net income. They file what we call a Schedule C. I take their Schedule C for the last 2 years. I look at their net income that they're paying taxes on to the IRS, and I average that out, okay? FHA allows for a higher debt-to-income ratio than the conventional product. So that's why there's a myth in the industry that you have to put 20% down and conventional is a harder loan. It's not. Conventional is not.
Yeah.
You could put 3% down, it just allows for a lower debt-to-income ratio, okay? So that's the main concern or the main difference between the two products. They're both gonna have mortgage insurance if you're over 80%. Sometimes you can even buy out the mortgage insurance if you're putting down less than 20%, but that's a different mortgage product, and it's my job to put the first-time home buyer or any type of buyer into a house and get their payment the best I could possibly get, the lowest possible payment, okay?
Yeah.
Sometimes, believe it or not, the best program for a specific buyer is not gonna be the best interest rate. So I could explain that, where sometimes the conventional interest rate might be slightly higher than the FHA interest rate, but the mortgage insurance is substantially cheaper than the FHA mortgage insurance. So it's my job to figure out both aspects. Can they go FHA? Can they go conventional? Yes, the answer is yes to both. Which program is going to give my client the lowest monthly mortgage
And
payment?
of course, that's when you come in, Joe, and you advise, you know, all of the first-time home buyers which is the best route, and you always try to get them the best deal they can.
Correct.
Um,
Correct. And I look at their credit. We go over their income.
Yeah.
We go over their job history. You can have gaps in jobs. That's another myth in the industry. A lot of times people say, oh, I'm not going to be able to apply for a mortgage yet because I just changed jobs. No, that's not the case at all. You can have a gap in employment. As long as you're somewhat staying in that same industry or capacity, we can still get you a mortgage. And you can have gaps of employment. We just need an explanation on what happened. Life happens. Jobs close, you move on to another job. Divisions get laid off, you move on to another job. We all take that into account, and buyers can still get a mortgage. The other thing we look at is assets. We want to know how much you have in the bank. We want to know your savings. We want to know, you know, do you have a checking and savings? Do you have a 401k? You know, a lot of times we don't care if you have a 401k or not, but that may help because you have a savings, a nest egg. So God forbid something was to happen in your life, that you have something to fall back on.
Right.
So I take those three things into account when I do my pre-approvals. I look at that income. I look at the job and at the assets. I look at the credit. I look at all of that, and I take it as a whole, and that's how I determine what type of program is best suited for the borrower.
Okay, Joe. Yeah. So that's good. That's it for today, guys. I just wanted to have Joe here today. He'll come and speak again. I'm sure in the near future.
I appreciate that, Tommy.
Yeah, no problem, Joe. Thank
All
you,
right.
everybody.